In her role as fiduciaries, IFA's wealth advisors must put their clients' interests first, not their own. That means trying to avoid conflicts of interest that can arise from accepting commissions and selling proprietary financial products to investors aren't allowed. In short, our wealth managers stick to providing financial advice. Often, however, our wealth advisors are asked about insurance-related matters. Our wealth advisors stress that investors refine their searches to agents who are fee-based and don't charge on a commission basis. One of those we've referred clients to in the past has been Scott Witt. Why Scott? It's probably important to know that Scott left an established and secure career as an insurance company actuary to become a fee-only insurance professional. He founded Witt Actuarial Services in 2007 and became a very public advocate for consumer-friendly yet comprehensive insurance advice in the U.S. Hi, Scott. Thanks for taking the time today to talk a little about insurance.
Yeah, good morning. Happy to be here.
I don't think a lot of people know that they've got a choice when picking who to work with and trying to sort through the maze of different insurance products out on the market today, that you can choose not to pay commissions on everything, and you can find, like you can with a financial advisor, a good insurance agent who charges on based on fees, correct?
Yeah, it is complicated, and I agree with you that there's not a lot of widespread knowledge about the different options that are out there. Just one point of clarification, I'm not actually an insurance agent. I can't place the products myself. There are very few options that exist in the marketplace where you can avoid commissions entirely. There are certain niche products, and I'm sure those will come up later in our discussion. But for the most part, I am working with clients to figure out what they need, and we're considering all of the alternatives, some of which have no commission, some of which have low commission, and some of which unavoidably have full commission. But the one thing that all of those options share in common is that no matter what my clients choose, I get paid the same. I'm only paid on an hourly basis or a project fee basis, and under no circumstances do I get a commission or a kickback. I have no financial incentive to steer a client one direction or another. And therefore, clients know that they're actually getting true fiduciary advice, and advice that is free from conflicts of interest.
So you can actually research and shop for people what the best plan of attack might be.
I can. And because of the way that my business is structured, I have access to the entire universe of products. I could work with a proprietary agent, for instance. Some companies have exclusive relationships with their field force, and you can't get access to their products unless you work with a member of their field force. Other companies have more of a brokerage model where they're willing to work with different brokers and agents. And then there's at least one prominent company that has a no-load option where you can work directly with the company. But in my experience, I've found that to be only appealing for certain segments of the marketplace.
Okay. And when we're talking about insurance, I guess the big things people are talking about these days is whole life versus term, that sort of thing.
Yeah, I think an even broader distinction I would make is that I would characterize permanent life on one end of the spectrum and term life on the other end of the spectrum. And then within that permanent insurance category, there's things like whole life, universal life, and then specifically within universal life, you have guaranteed universal life, indexed universal life, variable universal life. There's lots of different flavors of permanent insurance, and that's where a lot of complexities tend to come in. On the other side of the spectrum, term insurance is fairly vanilla. There can be some bells and whistles and some intricacies, but by and large, people tend to have a pretty good understanding of what term insurance is. You're covered for a set period of time. If you die within that period, your beneficiaries will get the death benefit. If you outlive the coverage, they won't get anything, but you will have had the peace of mind of having that coverage all along the way.
So how do you pick which one to choose to use? I mean, does everybody need permanent insurance?
No, I would not say that everybody needs permanent insurance. I would say that the vast majority of people do need term insurance at some point in their lives. And generally speaking, Americans are underinsured. Many people don't have term insurance that need it. And many people that do have term insurance only have 1 or 2 times their salary through their employer, and they should really have more than that.
Why is that?
Well, I try to put my clients through a thought exercise and say, if you were to pass away today, what would you want to accomplish financially for your dependents? And that's a needs-based approach. Do you want your spouse or significant other to have to continue to work until retirement? Do you want them to have to pay the mortgage, or would you want to pay that off? What about your kids' college educations? Things of that nature, and it's going to be a different answer for every client, and different clients have different amounts saved up at the point in time which you're having the discussion. That is a needs-based approach. Insurance agents like to take an income replacement approach, and there's not anything wrong with that, but some people view this more from the standpoint of, I have gone to school for a number of years. I've got professional training. I've got my education at a certain level. I'm established in the industry. I've carved out a certain income level. And what is the present value of the future income stream that I'm going to earn between now and retirement? And you can quantify a human life value, so to speak. Sounds a little cold, but you can value the future earning potential of an individual and discount that back and say, this lump sum, if your beneficiaries receive this today, this lump sum would basically put them in the same financial position that they would have been in had you lived through retirement and made the salary that we're assuming you're going to make. And you can make some tax adjustments and everything, but that number is usually quite a high number. It might be 15 or 20 times your salary, depending on how old you are. And most people don't have that much insurance. I'm not saying everybody needs that, but that's often a starting point in a conversation with an insurance agent. And then you may work back from a needs-based direction and come back off of that number. That's a long answer to your original question. Most people do need insurance. By and large, they need term insurance. And then you may have a secondary question about, well, do I want, or do I need some permanent insurance on top of that?
Okay. And what about, do you deal with, long-term care insurance and those sort of health related matters?
I do provide advice on long-term care insurance. Typically, that conversation is at a real high level about, do you need long-term care insurance or not? It's often not a very pleasant conversation because that particular risk is not handled very well by the insurance marketplace. And so even people who buy a policy who think they're getting peace of mind often are only getting coverage for 2 or 3 years and don't have the catastrophic protection, or protection against a catastrophic event that they might think that they have. And so it's not a particularly satisfying discussion, but a necessary one nonetheless. And long-term care is a very difficult risk to manage and to protect against.
In general, do you find your advice leaning towards the side of self-insurance in those matters?
Well, there's a certain level of wealth that once you attain, you theoretically could self-insure.
Mm-hmm.
And just as a rough rule of thumb, the guide that I use, if you could write a check for $1 million today and not dramatically alter your lifestyle or your standard of living and your peace of mind, you have enough money to largely self-insure. Because if you look into the future 20, 30, 40 years, you think about a pretty serious event that would require skilled nursing care, you're in a nursing home, and you discount that back to today, you're going to get somewhere in the low seven figures for what that type of event costs in terms of present value dollars. So if you could stomach that today, you probably don't need long-term care insurance. Ironically, it's those people who are in the best financial position to actually afford catastrophic long-term care coverage. And some of those people choose to do it because they would rather write a check for, let's say, $100,000 or $200,000 today in exchange for knowing that they're not going to have this this equivalent of a $1 million present value event down the road, which many years in the future might be a multi-million-dollar event. And they would rather have that certainty of taking care of that long-term care risk. They can maybe do their other estate planning more efficiently and more confidently. The problem area is when you get to an intermediate level of wealth where a long-term care event could potentially wipe out your net worth or hinder you from accomplishing a lot of your financial goals, yet you are not financially able to afford the premiums necessary to provide that level of risk. And so there's this constant tension for people with this intermediate level of wealth, which could range anywhere between 1 million and several $1 million. That's a very difficult decision. If you have less than $1 million of net worth, I find it hard to justify spending much on long-term care coverage because you probably haven't taken care of some of your other needs. And the only policy you're going to be able to afford is one that you've cut back on a lot of the things that make long-term care appealing. You may not have got inflation protection. You may have a really short benefit period. And in those situations, those people may have no alternative but to rely on family members to self-insure, rely on something like Medicaid to kick in if and when you run out of assets, or just roll the dice that you'll be one of the ones that won't need long-term care. But you can see the complexity of this conversation and how it often doesn't have a happy ending in the planning process.
Sure. So roughly maybe 1 to 5 million, it's still kind of questionable. So it's less than 5 million. It might be worthwhile to look at self-funding.
Yeah, I think that's fair to say. It's going to be different in every situation. You know, some consumers have a family unit that will not require them to have any form of long-term care until maybe the very end of life. Other family units may be in a situation where they know as soon as they lose some of their activities of daily living, they're going to require somebody other than a family member to take care of them. And so it's hard to paint with a really broad brush when it comes to long-term care insurance. It's also going to be different from consumer to consumer based on their own risk tolerance, their viewpoint of their own longevity. If they've had experience in their own family where they ended up taking care of somebody from an older generation, perhaps because they didn't have insurance. So I find that even individuals that on paper are seemingly in very similar situations, they can have radically different viewpoints of long-term care insurance and may end up in radically different places with respect to whether or not they get insurance or how much. And they both might be totally fine with that. So again, it's one of those areas that it's very important to drill down into the specifics with the consumer and figure out what makes the most sense for their situation.
Sure. And regardless of where you think you are, it might be a good idea to talk to you at least to make sure whether self-insurance will work for you or if it's not a good idea.
Yeah, and the other thing that I'm sure many IFA clients are encountering is that they maybe bought a long-term care policy a decade or more ago, and now they've seen those premiums start to increase, and they're trying to figure out what to do. And I can help clients navigate that process and just think through whether it makes sense to let the policy go, to pay the extra premium, or to find some sort of a happy medium where maybe you keep paying the same premium, but you have to give up on some of the benefits in order to keep the policy in force. So again, it's not a real happy situation, but it's one that needs to be handled nonetheless.
Sure. And for IFA clients who are interested in insurance matters like these, you can reach out to your IFA wealth advisor, and they can get you connected to Scott pretty easily. Thank you very much for your time today, Scott.
You're welcome. Thanks for having me.
Thanks.